forms, they've learned enough to know they should stay the course and keep putting that percentage in. And if, as we would expect over time at a 10-year horizon, a 15-year horizon, a 20-year horizon, it has outperformed, you're right that they could rebalance by putting nothing in that year or putting less in. What I would like to think, though, is that as they gain confidence in the asset class, that they would stick with it. They'd say, hey, this thing seems to be working. I'll continue putting my 10% or 20% of my retirement savings into small cap value. Now, what that means for the portfolio overall is that it becomes more volatile, because if you have a higher allocation to this more volatile asset, then you're going to see deeper potential worst case drawdowns and more variation in your annual returns. And so you don't want to exceed your ability to stomach that and stick with it. But, hopefully if, as you get to those nearer years of retirement, you're an oversaver at that point and you've got more than you need, maybe you have a higher capacity then to tolerate some of that volatility as well. But that's a very personal thing. And if you feel like, if an investor feels like the volatility is getting to be too big for them, they could rebalance even within the IRA. They could go in and rebalance. They could say, I'm going to take a percentage of this small cap value and move it into large cap blend to balance things out. And they wouldn't have tax implications or capital gains to realize. So they could do that as well, or even incorporate some fixed income if needed. And I think we give them all the tools to figure that out if you look at the portfolio as a whole. So I think they have a lot of levers. I think it's a great strategy. And it's impossible for me to model all the scenarios that would happen, but I think there's enough positive options down that path that it's a good one.
Let's put that table back up just one more time and see if there isn't one more lesson on there that we can leave for our I keep using the word students. I don't know if that is demeaning or not, but the people who are looking to us to learn something. When I look at this table, and we're talking about the 25-year-old person that gentleman was asking about, how do we use this table to create a lifetime of returns? I think most of our folks know how to use a calculator. They can't go to our lifetime investment calculator to do that with the target date funds at this point. But walk us through how you would show those 25-year-olds how they would likely do over a lifetime.
Well, it's a little bit of a tricky math problem, because what you're going to get is whatever box you're in over time. If you stay in let's just take the simplest case, the target date fund. Let's say you go 100% in the target date fund throughout your life. Well, when you're age 25, you're going to get historically an expected compound annual growth rate of 9.8% with this drawdown. When you have a little bit more money, you're going to get a little bit lower return, and so forth and so on across the chart. And when you're nearing retirement and you have the greatest amount of money, you're going to be getting these returns of 9.0, 8.7, and 8.0%. It's really hard without building an Excel spreadsheet and putting in some savings rate and then following through with what you think the compound rates of return are, to say what your total would be, what your total experience would be. And that's why in the book I ran all of these different scenarios with rolling start dates, was so you could get an idea of what the history says a bad luck scenario would be, a medium luck scenario, a good luck scenario. I think though that what people are going to try to do probably is get the best return that they can at any point in time for whatever their risk tolerance and capacity is. So we know that our risk capacity declines over time because we have fewer years to work. And so we should probably be seeing the volatility and the worst drawdowns decline as we get closer to retirement. Plus, we're probably more nervous about the size of the balance.
Yeah.
But within that constraint, there's also an emotional component, which you've brought up with your fine tuning tables, that as an advisor, you sat across the table and talked to people and said, would you be okay losing 50% of your retirement savings? Mm-hmm. And the truth is, most of us probably overestimate by a little bit what that capacity is, because it's easier in the abstract to say you could tolerate something than in the concrete. When the market has gone down 50% and there's no evidence it's ready to turn around, that's when it's really, really hard for people. And so I think people are going to look at this chart and they're going to find their comfort zone year by year as they go across it. And that may mean moving up and down on the chart in the amount that they have allocated to small cap value. It may mean just riding all the way across in a row. And in terms of their expectations of return, it's going to be that dollar weighted average, which depends on how fast they save at different ages and what their luck has been. Yeah, it's hard. It's a hard question to answer.
Got it. By the way, I just realized that there are a couple more Two Funds for Life questions that could be quickly.
I'm game. I'm game.
Okay, good. And that is, in the small cap value, would you be endorsing a combination of international and U.S. small cap value as opposed to only U.S.?
Yes, and I think that comes down to a personal preference and comfort level. The target date fund is going to give you international diversification already. It probably will tilt to the United States. So if you want to maintain the same allocation that the target date fund has, say something like a 65-35, I think that's close to what Vanguard has right now. You could do that same allocation between a U.S. small cap value and international small cap value. Or if you feel uncomfortable with the target date fund tilting too much internationally, you might decide to be 100% small cap value in the U.S., 100% U.S. in small cap value. So I think that's a personal thing. It's hard with any statistical significance to say how that's going to change the return, because we just don't have enough history on international asset classes compared to the United States.
And we do have tables, fine-tuning tables for a worldwide small cap value portfolio, so that both 50-50 and 70-30.
Yes, we do.
You can go check those out on the page, the fine tuning your asset allocation page in the boot camp. Something, I think we've done it, Chris. As always, you've done a great job, and appreciate your time. And we'll get back together and we'll be talking to them about best in class. I know one of them, they want to know right now. They want to know. They do not want to wait. They want to know when you are going to update the list of ETF recommendations.
I will update it at the beginning of 2025. I'm going to stick with my 2-year cycle. I haven't seen anything yet to make me think we need any kind of interim update. I feel like the recommendations we have there are still very solid. And one of the challenges, because a lot of people, they see a new fund and they want me to evaluate it right away and say, is this better or worse? One of the challenges is a lot of times there's not enough history. There's not enough time to analyze to really know what the fund is doing, how it's performing. And A lot of times that goes along with a lack of liquidity too. When a fund is new, the assets under management are small, you can see bigger bid ask spreads, and that makes it harder to trade efficiently without paying a penalty to the smarter trader on the other side of the trade. So I think by the time 2025 rolls around, we'll have some interesting new candidates that have enough history and enough assets under management that'll be a worthwhile exercise. But for now, I think we've got great recommendations and still very comfortable with them.
Great. Chris, thank you very much. Thank you to all of you who join us on a regular basis. One of the best things you can do to help us is to share this information with others. And by the way, many of you have recently sent donations to help us in our work. That is greatly appreciated. And we are a 50C3 nonprofit, so it is, if appropriate, tax deductible. But most of all, we really appreciate having the opportunity to help you and your family. Good luck.